You've probably heard the whispers, or maybe you've read in the media, that the taxman is on the hunt. The Australian Taxation Office is implementing some innovative strategies and forming new alliances in a bid to recoup billions of dollars of revenue deficit. This means Australian property investors should be on high alert and make sure they've completed all their obligations correctly. Now, to discuss how to avoid getting trapped by the taxman, or maybe I should be more politically correct and say the tax person, today I'm joined by Rob Thompson, Assistant Tax Commissioner at the ATO, and we're going to discuss some things that I think are going to help you understand your obligations and also stop you from getting into trouble, particularly a number of aspects that relate to property investors. There's so much to discuss. I'm going to have Rob on the show again next week, but today I want to give you some insights into what the ATO is looking for this year. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I'm old enough to remember the media fuss when the late Kerry Frances Bulmore Packer famously said, "I'm not evading tax in any way, shape or form." Now, of course, I'm minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you, you're not spending it that well, that we should be donating extra. Now, that's what Kerry Packer stated in his November 1991 statement to the House of Representatives Committee on Print Media. And if you're like most property investors, you're going to want to legally minimise your tax too, but not get tangled up with a taxman. So in today's show, and in one episode next week, I'm going to be chatting with Rob Thompson, Assistant Commissioner at the ATO, to help you understand your obligations. Now, you're going to hear that the tax office is not out to trap you. They say Aussies are free to arrange their financial affairs in a way that keeps their tax to a minimum, as long as it remains within the confines of what's legal. However, not surprisingly, they're paying very close attention to unlawful schemes that deliberately exploit the system. Now, having interviewed representatives from the tax office for 3 years in a row now, I've found that they're really keen to educate you to ensure that you don't make the common mistakes that could get you into trouble. But today, before I have my chat with Rob, I'd like to share with you an overview of the areas that the ATO is looking at this year. In my previous chats with Assistant Commissioners of Taxation, I remember being surprised, in fact, shocked by the extensive data matching that they do to make sure everybody pays their fair share of tax. Not surprisingly, the ATO has got access to bank records, but they've also got access to property management records, residential real estate, bonds that are lodged on behalf of tenants, short stay accommodation records like Airbnb and stays, crypto, plus much more. This means it's going to be easy for them to identify what rental income you're receiving as a property investor, and they're going to be on the lookout for mismatches between what they know and the tax data that you report. And their clever computers keep track of everything to make sure you're declaring all your income. Apparently this year the tax department is going to be looking at not only property investment deductions, and I'm going to be discussing those with Rob Thompson in a moment, but other areas as well. So before my chat with Rob, let's have a look at some of the other areas they're going to be looking at, and maybe they're going to apply to you. First of all, they're going to look at work from home deductions. I mean, more and more of us are working from home now, either full-time or part-time, and the ATO have introduced a new hourly fixed rate of deducting home expenses. However, it's likely that the tax department is going to check your claims to get these tax deductions thoroughly, particularly to verify whether taxpayers have a record of working all the hours that they say. Maybe they're going to look at timesheets, a diary, copies of work rosters. In other words, can you really substantiate your claims from working from home deductions? I read that they're going to particularly focus on people claiming the whole or substantial part of their mobile phone bills as work-related, but potentially double-dipping and claiming them in the work-from-home rate as well, which includes an element of mobile phones, rent, mortgages, internet, things like that. As usual, The tax department's also going to check motor vehicle claims carefully. You're going to hear my discussion with Rob Thompson next week that there are two ways of claiming motor vehicle expenses. But also, a number of years ago, the tax department stopped investors being allowed to claim expenses for visiting their investment properties. Interestingly, when the ATO examined property investor records, they found errors in around 90% of all tax returns. 90%. This suggests that they're going to focus on ensuring that excessive interest expenses aren't claimed, incorrect portion of rent and expenses from various owners of the property are going to be claimed correctly. That's when properties are jointly owned. We'll be discussing this in a moment anyway. And I know the tax department's also looking out for holiday homes that aren't genuinely available for rent. Property investors are only allowed to claim deductions for the period where the property is rented out or genuinely available to rent. Periods of personal use for your own holiday can't be claimed. In fact, I remember in my discussion last year with the Assistant Commissioner of Taxation that they check records on sites like Airbnb to make sure that you're not overcharging at a particular time of the year to ensure that your property ends up being vacant because you're charging too much, and that allows you to use it personally but claim it that, hey, it was available for rent. So the golden rule is if you can't substantiate it, you can't claim it. So it's essential to keep invoices, receipts, bank statements and records, as well as proof that your property was available to rent. I know another area that property investors got themselves into trouble in the past, incorrectly claiming the cost of repairs. When they purchased an investment property, a new rental property, you see the cost of repair damages or defects existing at the time of your purchase, or the cost of renovating at the beginning of your ownership of the property before you put a tenant in, they can't be claimed immediately. They can't be claimed as repairs. Now, some of them can be claimed over a number of years by getting a depreciation schedule. Others are capital costs. Another area that ATO is carefully looking at the moment is side hustles from organisations such as Uber or Airtasker. With more and more of us tapping into this shared economy, many Australians aren't properly declaring the profits or their income. If you're receiving work from the shared economy, it's important to know the tax department's receiving reports from these platforms, including Uber, and that can highlight mismatches between what you're receiving and what you're declaring as income. And as I said, this also applies to renting properties or even part of your own home through platforms like Airbnb or Stays. By the way, are you one of the many Australians who've invested in crypto over the last few years? Well, the ATO estimates that somewhere between 500,000 and 1 million Aussies have invested in crypto, and they've warned that they're being provided data on purchases and sales and can identify taxpayers who may not be disclosing income from investing in crypto. To help them in their research, the ATO is collecting bulk records from Australian cryptocurrency designated service providers. Again, this is part of that big data matching program to ensure people paying the right amount of tax, and in this case, people trading cryptocurrencies are paying the right amount of tax. Similarly, the tax department's watching Australians who buy shares to ensure they pay capital gains tax on their profit. However, if you regularly buy shares and sell shares, it could be seemed that you're maybe a share trader rather than an investor. And in that case, the tax you pay is going to be very different on your gains and your losses. It'll be treated as ordinary income rather than capital gains tax, which is paid at a lower tax rate. Now, remember, I'm not licensed to give you tax advice. What I'm talking about at this point is really just general discussion to make you aware you should get the correct advice from your tax accountant. And the aim of this preamble before I talk with Rob Thompson is just to make you aware of the many areas the tax department's carefully looking at. Look, I hope you also recognise that treating your property investments as a business, and you are in the business, you're in the business of providing rental accommodation to people who are prepared to pay you for your services. If you treat it as a business like other businesses, there are rules and regulations to follow, some related to the Residential Tenancies Act in your state, and others, federal regulations like the tax department. In my mind, to be a successful investor, successful in your business, you need to have a business plan. In fact, that's what all businesses do, don't they? I mean, planning's bringing your future into the present so you can do something about it now. So as our markets keep moving on, our housing markets are going to create significant wealth for many Australians who run a service business providing rental accommodation. Statistics show that 50% of those who are going to buy an investment property this year are going to sell up in the first 5 years. And of those who stay in the market, 92% will never get past their first or second property. I guess it means that attaining wealth through property doesn't just happen. It's a result of a well-executed plan. So just to make things clear, buying an investment property is not a plan. It's not a strategy. It's important to start with the end game in mind and understand what you need and what you want to achieve. And then you've got to build a plan, a strategy to get there. Again, treat it like a business, because the property you eventually buy shouldn't just be coming from your thoughts or your emotions. It should be the physical manifestation of a whole lot of decisions that you make, and you make in the right order. That's because, as you keep hearing me say, property investment is a process, not an event. So if you're a beginner looking for a time-tested property investment strategy, or you're an established investor wanting just a second opinion, an objective second opinion about your portfolio, why not get my team at Metropole to have a chat with you and help you build a personalised, customised strategic property plan, because that's going to help you define your goals like a business should. That's going to see whether they're realistic, especially for your timeline. Interestingly, only a couple of days ago I spoke to somebody who's 40 and she wants to retire at 45 and she'd like $1 million worth of passive residual income, $100,000 a month. Really? It's not realistic. It's not possible. But she's been reading some of those interesting, let's call them blogs, and getting those interesting messages on social media. And she believes she can do it by bypassing the banks, even if she hasn't got the money. These people are selling her tickets to see unicorns. So that's why you need a plan to make sure your goals are realistic, measure your progress towards your goals, find ways to maximise your wealth, and at the same time identify risks. So if you want to find out more about how Metropole can help you, go to metropole.com.au. We're much more than buyer's agents. We help our clients safely create intergenerational wealth through strategic property and wealth advice. Okay, so now let's move on to the second part of today's show, where I chat with Rob Thompson, Assistant Commissioner at the ATO. In today's, well, let's call them interesting property times, investors are watching their expenses, and one expense everybody wants to minimise is their tax payments. Now, there's nothing wrong with legally minimising your tax, but on the other hand, you don't want to get tangled with the tax department, do you? So in today's show, and again in a podcast next week, I'm going to be speaking with Rob Thompson, Assistant Commissioner of the Australian Taxation Office, to guide you through the tangled tax web. Welcome, Rob.
Thanks, Michael. Great to be here.
Well, Rob, there are so many different things to be aware of when it comes to owning a rental property. But today, let's focus on the tax implications of the borrowing expenses, interest expenses, and how we apportion them. And I'd like to ask you a couple of other questions along the way, if that's okay.
That sounds great, Michael. You know, for property investors, there's definitely a few things that are on our radar with respect to the expenses they claim. So looking forward to the discussion today.
Now that's going to scare some people. They're going to be on your radar. There's nothing to be scared of as long as you know the rules and the regulations and know how to do it. So I think the purpose behind these chats with you is to make people aware of their obligations and how to do it right so that they don't have to be worried that the taxman's looking at them.
That's definitely correct, Michael. We're all about wanting to make sure investors understand the tax consequences, you know, both even before they invest in a property, but like once they've bought an investment property, they understand the tax consequences, educate them up front so that when they lodge their tax return, they get it right the first time, and then don't have to worry about the ATO coming and ever asking them any questions.
Good. Well, look, I've often said that property investment's a game of finance with some houses thrown in the middle. And while, interestingly, a recent report showed that a third of properties are being bought with cash, the bank of mum and dad or wealthy baby boomers downsizing, still the vast majority of property investors get a loan. And while they recognise that the interest is tax deductible, Rob, how do we treat the other expenses associated with borrowing money for investments?
Before anyone buys a property, hopefully they've had a chat with their registered tax agent or referred to the ATO's website around some of the basics, kind of around what you can and cannot claim. So they kind of understand what they can do up front before they buy the property, and there's no surprises later on.
Wouldn't that be nice if people plan, Rob? Unfortunately, they don't. So this is really a good conversation to have because you've got to plan to become the people you plan to become. A lot of people get excited by a property, an investment, and they don't think through all the cash flow consequences. So thanks. I think that's a great point to start with. Get advice before you do something. Don't get too excited or emotional about it.
That's right, Michael. And probably one of the main costs, I think we'll talk about interest a little bit later, but one of the main other costs is your borrowing expenses. So, there are a bunch of costs that are considered to be borrowing expenses, and, they're incurred when the loan's taken out. And they include things like your loan establishment fees, title search fees, mortgage lender's insurance, the cost of preparing and filing your mortgage documents, and even the stamp duty charged on the mortgage. Now, we're making sure that stamp duty charged on the mortgage as opposed to stamp duty that's charged on the property itself.
Yeah, very different, aren't they? In fact, most people don't even know there's stamp duty on the mortgage. One's deductible, one's not. So let's talk about that.
That's correct, right? And so when your borrowing expenses are $100 or more in total, which I mean these days is everyone, right?
Yes.
You need to calculate and spread that borrowing expense over 5 years or the length of the loan, whichever one's shorter. Most of the time that's going to be the 5 years. And odds are as well, you won't be buying the property, bang on 1 July at the start of the tax year. So you'll need to prorata the first and the last year's numbers of the days you can claim over that 5-year period. But remember to hang on to your records, kind of showing how you've calculated this in case we ever ask to see it. Michael?
Now, that's an interesting point. I think people got to remember they have to hang on to their records. Good record keeping is important for you, for your accountant, and if ever the tax department looks at you. So if I know you want, I'm sorry I interrupted your train of thought, Rob, but I think it's an important point to make that if you've, let's say, got $500,000 worth of expenses up front to get your mortgage, it's a cost of doing business as a business owner providing rental accommodation. You can write it off, but that's not really $100 a year over 5 years. It could be $50 in the first year because you've only got half a year of expenses. So you've got to watch that, don't you?
That's right, Michael. And look, borrowing expenses, there's a lot of good information on the ATO's investor toolkit that kind of online that allows you to kind of understand what expenses are and aren't borrowing expenses, and really good examples on how you can calculate those borrowing expenses and deductions over 5 years. You've talked about records. They are very important, Michael. And I also need to mention there that, why the things that aren't borrowing expenses, they can still be claimed under other labels of the tax return, like your interest expense, or there's other fees, like conveyancing fees, etc., which are actually capital costs. And they're going to come into the equation when you sell the property and can get included in the cost base for working out your capital gain. And I know we're going to talk about CGT in a future podcast, Michael. So, setting up your records from day one, both with respect to what you can claim straight away or over a 5-year period, or what you might need when you dispose of the property, are all really important.
Okay. Well, you mentioned a fact sheet. There's a lot of fact sheets the tax department offers. So I'm going to leave a link in the show notes and people can go to that particular page so they can get an idea of what's going on. So one expense, as you said, and that's often forgotten, is these borrowing costs. It's the cost of establishing your loan. And as you say, they can be written off over the period of the loan or a 5-year period. What about interest expenses? Because that's one of the biggest ones, isn't it, really, Rob?
It is, Michael. So like when you have a rental property, odds are for a lot of investors that they have a loan and they're paying interest on it. So interest paid is immediately deductible, but only the interest for the rental property. And what we see is that incorrect reporting of interest expense accounts for 42% of the tax gap for rental properties. And I know probably tax gap sounds
now,
like...
Now, what's the tax gap? That sounds like fancy tax department conversation, Rob. Tell me.
It sounds very tax technical, doesn't it? But really all it means, Michael, is it's the difference between the tax that should be paid and the tax that is paid. So it's the theoretical difference. And for the rental property market, we for rental properties, Our last calculation is that that's about $1.2 billion a year.
So people are claiming $1.2 billion of expenses they shouldn't be?
Yes, or income.
Or tax deductions. Yeah, sorry, yeah.
Yep. But still, with respect to, the tax paid on rental properties, investment properties, the tax gaps, the difference between what should be paid and what is paid is we calculate it at about 1.2
That's
billion.
a large amount of money.
Michael, I'm sure both you and I wouldn't mind that kind of cash. But, it's also important that we get that cash in to build more schools and roads. So, that's why we're here talking to everyone. And so interest expense, or the incorrect claiming of interest expense, accounts for 42% of that 1.2 billion. So actually a fair amount of money. And so, one of the areas where kind of we see this mistake is apportionment. And so that's kind of between, where you take the loan out, and you might take the loan out for an investment property, but you also might use some of the money, say, to buy a new car. This is where we find people start to make mistakes, Michael. So there's two bits here. The first bit is that you need to apportion the interest expense on the loan every year between the amount of the loan that's being used to finance your investment property and the amount that you've used for the private use, like buying a new car. So, the second thing you need to do is to remember that you have to do that for the life of the loan. So say you borrow $400,000, probably more these days with the price of property, but let's use $400,000.
Okay, it's a figure I can work in my head. Thank you.
Michael, say you use 50 grand of that to buy a new car, or to contribute towards, and the other 350,000 is used to finance the property. You can't just pay the first 50 grand of the loan off and say, all right, I'm done with the private expense. From now on, I can claim the 350, all the interest on the remainder of the loan. You need to, it's not done like that. You need to continue to apportion it for the whole life of the loan. And so once again, I've talked about our investor toolkit, but we've got a lot of good examples there that kind of explain how you can calculate this and how you can work, because it does get a bit tricky. If you throw on some refinancing there as well, adds to the complexity. So, make sure, I think would say to your listeners is make sure if you've taken out a loan, you've used it for a mixed purpose. Make sure you've got really good records explaining that and have a look at our website.
Well, usually when people buy an investment property, they take out probably two loans, sometimes against their existing home, equity for a deposit, and then there's the loan the bank gives you when you buy the property, and usually there's nothing left over in that second loan, but the initial equity loan is often where it's mixed purposes, and you shouldn't taint that. I guess that also comes into account with offset accounts and things which we can talk about separately, but what you're suggesting is have proper documentation, and if possible, don't mix the purpose of the loans. It just makes it very complicated accounting-wise, doesn't it?
Well, Michael, how people want to structure their finances is completely up to them. That's not the tax officer's space. We would just say, though, if you are using a mixed purpose loan, that can add complexity, and then you need to make sure you've got good records around that.
Okay. Again, we give a disclaimer every time anyway. This is not personal, individual advice. It's not even personal tax advice. The disclaimer is this is general information and we're educating you, and you've got to go to your own tax professional for this. I'm not licensed to give that advice, and even though you probably are, you're not in the position to give it today.
That's correct, Michael.
Right. So we're talking about apportionment, but I think there's a few other things investors should be aware of. Is that right?
That's right, Michael. So look, the other big one with respect to apportionment, and we hear it on cafes, we hear it in public transport. Sometimes we hear our family say it to us, and you're like, hey, no, that's not how it works. We'll hear people say, oh, well, my partner, they earn less than me, so I'm going to stick more of the rental property income in their tax return so that we pay less tax. Now, some people might think that's a tax minimisation strategy, but it actually can have compliance aspects there. You can't pick and choose who reports and claims the income. It needs to be done in line with the title deeds for the property. So no matter who earns what, the deeds outline the legal interest in the property, And you need to lodge the tax return, the income and expenses, and apportion them in line with the title deeds. So,
Makes sense.
you've got two types, Michael, really, and I'm sure a lot of your investors are aware of these. You've got joint tenants who own the entire property jointly, like your mum and dad investors, and they'll kind of have joint tenants. So in those cases, you've got to split the income and expenses equally. And then you'll have tenants in common, right, where there could be unequal legal ownership in the property. So someone might own 40%, the other two investors might own 30%. So in that case, you've got to split the income and expenses consistent with their ownership structure, so 40, 30, 30. So really important there that people understand, people give regard to the legal ownership and the title deeds, and that they lodge their tax return and apportion the income and expenses accordingly to that.
Of course, there's other ways of owning properties as well. You can do it in your self-managed super fund, or many investors buy properties in trusts, companies, legal entities that are different. For that, you need specific advice, and there are ways to apportion certain elements according to the discretionary elements of a trust, but that's not what we're going to get into today. But we've discussed different ownership structures in this podcast before. Anyway, there's a couple of things that you've given us there to think about and digest. Do you have any other tax tips for today, Rob?
Just probably one or two last ones, Michael. Most people who have rental properties lodge through a tax agent. And ideally, have a conversation with them before investing in a rental property or making any major decisions to understand the tax consequences. Your agent needs the whole picture as well if they're going to give you accurate tax advice and get your tax return right when they have to help you lodge it. So understanding your rental reporting obligations and supplying them with complete records really helps the tax agents to help you get your tax return right. And so this may be just a matter of having a chat to the tax agent, about, what software they use, kind of how you can structure your kind of receipts and your records to help it make it easier for them. Do they have a spreadsheet they use? Do they have specific compatible software that you can use that might interact well with their software? So just remember, it's worth having a chat if you're using a tax agent, which we know, I think 87% of people who have an investment property are using. Worth having a chat with them to understand how you can get your records right and make it easier for them. But, remember that your tax agent actually has a duty to ask you questions. So they have a duty to actually ask you, if something doesn't look right around your expenses, and ask you for those records. They're required to do that. So, I think in a nutshell, make sure you have a good chat to your tax agent before you invest and while you're investing to make sure you can get your records and your calculations right.
Well, Rob, when we first got together to have a bit of a talk about what we could discuss, there were so many topics. We've broken this up to at least two chats, if not a third one coming up before the end of the tax year as well. So can you give us a quick rundown of what our next podcast will include?
Sure. So we're going to talk about our next podcast. We're going to give you, some tax time tips because we know tax time's coming up. So probably just not on property. But we're also going to talk about selling your property and the capital gains tax implications of that.
Well, that sounds like a plan, Rob. So before you go, can you tell us where investors can go to get a bit more help, a bit more information about this?
So, Michael, I think I've mentioned our investor toolkit a few times, which is on the ATO website, ato.gov.au. And I know, Michael, you said you're going to put a link up, so that'll be super useful. Look, it has a bunch of information there to help your listeners, through working out some of these tax aspects, how to structure their records. Also, we have a series of videos that are quite easy to watch. So please do have a look at our website. Lots of good information there. Or alternatively, make sure you go and have a chat to your registered tax agent and they can help you as well.
Well, if you're going to treat your property investments like a business, and that's the only way you should do it, then you really should have an accountant, a registered tax agent, somebody to give you advice, because clearly this is a very specialised field. Rob, we only just touched the surface of the many tax implications. And if you treat it as a business, as I keep saying, then this is an important part of running a business properly. So I look forward to catching up with you again next week when we can talk about those other things. Thanks for your time, mate.
Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to show you 11 valuable insights into how to fail at life. Hey, what's Michael talking about? Well, you wait on and you'll hear, because I found, generally speaking, people live their lives in one of two ways, either happily and successfully or miserably with loads of regrets about what could have happened. Those who are happy and successful don't necessarily have a more blessed or lucky life than the other mob. In fact, they could live in the same type of house, have the same family situation, have the same job, have the same assets. So what sets up these two polar opposite ways of living apart? And personally, I think it's got a lot to do with how we choose to live our life, with the things that happen to us as we go along the way. You see, let's take mistakes and failures. While perceived mistakes and failures knock some people down, it knocks them down for a long time. Others learn from them. They get right back up. They just do things a bit differently according to the lessons they've learned. Now, I remember one of my mentors, Jim Rohn, the late Jim Rohn, once said, "It's just too bad that failures don't give seminars, because understanding why some people never seem to get anywhere in terms of happiness and success, no matter how hard they try, that could be a very valuable learning tool." So in today's mentorship session, rather than giving you the standard 10 tips on how to be successful or something like that, I'm going to show you 10 things you should never do if you want a rewarding life. Or maybe we should actually look at it differently, tips that you should do if you want to fail. So the number one thing you should do if you want to fail is just cruise. Go along day by day. I mean, who needs to set goals? Why don't you just wait and see what happens, what takes your fancy when you wake up, and stumble along through each day? If you want to fail in life, the next thing you should do is stay in your comfort zone. Think about it. To grow as a human being requires work, and more often than not, it requires embracing the unknown. But I don't want to stress. Instead, just remain safely in your own little cozy zone. As we're looking at things you should be doing if you want to fail in life, one of them is just believe in nothing. Cynicism requires a lot less work than believing in something, because if you do, then you might actually have to do something about it. So why don't you just go around pointing out flaws in everything and always looking for what could go wrong? If you want to fail in life, talk a lot. I mean, why bother listening to what other people have got to say? After all, you know it all. So make sure you tell your story, and you tell it often, no matter how much it bores other people. The next tip on how to fail at life is don't risk failure. The answer is don't try, because we all know the best way to avoid rejection and pain is not to do anything. Of course, you should also take care of number one. Maintaining friendships and relationships, that takes time and energy, not to mention the potential sacrifices you might be forced to make, and the sheer inconvenience of it all. Why not just look after yourself? That's all that matters. Again, surefire way to fail in life is never take the blame. Apologising or being responsible for your own actions, oh look, that's so yesterday. Just look at all the litigation that goes on in our modern world as people seek to find somebody else for the fault that's going on in their life. Remember, it's always somebody else's problem, not yours, isn't it? Another way to fail in life is sleep a lot. Make sure that you sleep a lot. Sure, there are only so many hours in the day, but why spend them accomplishing things and progressing? Well, you could be getting a bit of sleep. Another way, of course, is always defend your point of view. Remember, that's the only one that counts. If somebody disagrees with you, don't let it go unchallenged. Make as much noise as you can until they give up on the debate. Another way, of course, is to stay guarded. Trust can easily lead to hurt, to heartache. So keep your walls up. Don't let anyone in. Never, ever. Of course, the last message I'm going to give you about how to fail in life is always expect the worst. If you walk around expecting something good to happen, chances are you're just going to get disappointed anyway, aren't you? So don't risk that self-doubt and angst that can accompany unmet expectations. Surrender instead to the philosophy that life sucks. So in conclusion, if you want to live a self-fulfilling prophecy of life full of disappointment and despair, and ultimately be a loser, just follow these 11 ideas I've just given you. On the other hand, if you want happiness and success, perhaps see if you can have a long conversation with somebody who's never found success and learn more about what not to do. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?